The banks are getting richer and richer, and they are getting richer by manipulating homeowners like you and me. They are in the business of making money. They always have made money, and they will always make money. In this video, I want to show you how they make money by charging you higher interest rate and how the interest rate process works. And for you to be aware that when you buy a house, at the end of the 30-year period, that house is going to cost you double of what you paid. In other words, as an example, if you paid $400,000 for a house, you are going to end up paying up to $800,000 for that house at the end of 30 years. In other words, if you buy for $400,000, you are almost going to pay $400,000 for your house, plus another almost $400,000 just in interest rates. So let's look at how the process works. And I hope that by watching this video, you can understand how banks are manipulating you, how they are greedy, and how they make money off of you. So the more aware you are, the better decisions when you make, whether or not you are a homeowner right now. And if you are, there are ways to cut on your interest rate payments and the time to cut payments. And if you are a new homeowner thinking of buying a house, you are well educated to make that sound decision when you are ready to buy that house. This can be a wake-up call. In reality, banks are getting richer and they are keeping you poor with the high interest rate that they make money on. The best way to understand how the interest rate charges work, how the banks charge you, how much they charge you over the life of the loan, and how much money they make off of your house and your payments is to show you an example. So I'm going to run through a couple of examples so you understand. And here is one example, and we're going to make a lot of assumptions. So let's say you're going to buy a house for $500,000, and I'm using $500,000 as an example because I'm in Orange County in Anaheim Hills. The average or the medium home price is $1 million. Yes, a regular 4 bedrooms, 2 bath, 2,000 square feet home costs you $1 million, which is very expensive. Imagine buying that house at 6.5%, 7%. It's going to cost you $2 million or more over the life of the loan. And in some states, like maybe Montana or Idaho, there are homes available at $200,000, $300,000. So I'm taking a mid-range of homes depending on where you are located. The other assumption we're going to make is that you're going to put 10% down, which is $50,000. And the loan term is 30 years, which is a very common life of the loan. You could get 15-year loans or a 10-year loan or 20-year loans. But the most buyers get is a 30-year loan. This way, your mortgage payments are lower, but your interest rates are higher at the end of the loan. So if we take this example, as you can see on the chart, at $500,000 at 6.5%, 30-year loan with a 10% down, your monthly payment is $2,844 a month. This does not include your property taxes or your home insurance or your private mortgage insurance or your association fees if you have any. It is just principal and interest. So it's $2,844 for 30 years. In simple terms, if you get this loan for 30 years and if you pay $2,844 times 12, which is 30 years, 36 months times $2,844, you will end up paying for the house for almost $1 million. So let me show you this amortization schedule. It's a breakdown of your monthly payments, starting your first payment up to 30-year payment. And I want you to understand how much of your $2,844 a month that you're going to pay for 30 years is going to go towards your principal and how much is going to go towards your interest. So if you look over here in July 2023, assuming you buy on June 1st, 2023, because there's 30 days interest that they charge, out of the $2,844, your principal amount on your first payment is only $406.50, which is less than 15% of your payment is going towards your principal. And on your right, the interest is $2,437.50. In other words, almost 85.7% of your first mortgage goes towards interest and only 15% goes towards your principal. That's how much you're paying to the bank the first month. This is all profit to the bank. Now let's go back to end of 12 months of payments, December 2023. If you notice that your principal payment will be $417.63 and your interest in December 2023 is going to be $2,426.37. Of course, this is only 6 months away, not 12 months like I mentioned earlier. But even after 5 months of payments, only 14.68% of your payments going towards principal, and almost 85.53% is going towards your interest. Now, we can look further and see what happens 10 years after you bought the house. Let's say it's January 33, almost 10 years, 9.5 years after you bought the house, and you're still making those gruesome monthly ridiculous payments every month of $2,844, and assuming you're still at the same house and you did not refinance. So in January of 2033, your principal payments from the $2,844 is going to be $752.51, and your principal payment is going to be $2,091.49 per month. In other words, after 10 years of payments, you are still only accumulating 26% of your payments on a monthly payment, and almost 73 or 74% of that payment after 10 years is going towards interest. Yes, again, I'm going to note this. It's pure profit for the banks. They are making $2,000 a month 10 years later on your principal payment. So this goes on and on. Banks are loving this while you are day in, day out paying this mortgage payment, working hard, 40 hours, maybe overtime, taking care of your kids, taking care of your automobile payments, taking care of your insurance. Banks are laughing at you. Making this much money. You may think, well, you know what? After 10 years, I could refinance to a 3 or 4 or 5%. Well, yes, you can, and talk to your accountant. Maybe you want to. But here's what you need to think. You bought a house in, let's say, June 2023. 10 years later, you refinance. For 10 years, almost 70 to 80% have gone towards your interest. And now you refinance. Guess what? All that 70% of your payment for 10 years is gone out the door. It's vaporized. Well, I'm sorry. It's in the banker's pocket, not yours. And the really bad thing or the sad thing is now if you refinance, guess what? You're going to start the clock of 30 years in January 2033, assuming you refinance 10 years later. So now you start the clock again. So the house that you bought and thought that you would pay off in 30 years, now you're going to pay for 40 years. How old are you going to be after your 40 years payment? And how much hair are you going to have left on your head? After 10 years of payment, then you refinance, and all this interest is going towards the bank every month, and you are making a teeny bitty principal payment on it. So it's going to take you a long time. So in a way, you don't want to refinance, but you also want to refinance if you're paying too high. It's a catch 2023. Here's another question. Banks are in it to make money. After 15, 20 years, and you've paid every month, never been late. Let's assume you lose a job or you have a medical situation. And if you stop making payments, will the bank say, hey, don't worry, Mike, it's okay, you can start paying later? No. After 3, 4, 5 months of non-payment, they may foreclose on you. They don't care. You are just a number, 1/1,000,000th of a number on their files, and they don't really care. They will foreclose on you. They will not give you any leeway, absolutely no leeway. As I mentioned earlier, banks are greedy. Banks are in it for the money, and they will make money no matter what, even if you lose a house. By the way, while I'm talking about you paying high interest rate, there is a way to pay lower interest rate. I did a video. I will have a link at the end of this video. The video is called No More Mortgage. And in that video, I show you 8 ways to beat the bank. 8 ways to pay higher principal payments and faster principal payments, where you can pay off your mortgage loan in 27 years instead of 30 years, or 25 years instead of 30 years, or even 10 years before 30 years. So there is a way to do that. Please watch that video. There will be a link in the description and at the end of this video. So I wanted to show you this chart. It shows you the amortization for a mortgage loan. I wanted to show you how much you have paid over the life of this loan. So in this case, on a $500,000 house, your loan amount was $450,000, plus the total interest you paid at 6.5% for 30 years was $574,179. In other words, the total cost of the loan, because you only put $100,000 down, the total cost of the loan was $1 million and $24,179. That is financial slavery. That is financial greed. Just in interest, you paid $575,000, which is a lot of money in interest. That's not counting other costs that you have. Usually what we call, there's a payment called the PITI, which is the principal, interest, tax, and insurance. So on top of the $2,844, you are paying property taxes. Usually they pay on monthly. In this house, it'll be in Orange County, it'll be worth almost $600 a month. Your insurance could be $100, $200 a month. Then you might have association fee if you have a newer house, if you have a condo. that could be $200, $300 a month. So now all of a sudden the $2,844 is almost at $3,500 a month, not counting gas, electric, water, utility bills, TV bills, Netflix cost, Hulu cost. Now you're talking almost $4,000 a month in just payments out the door. You have to make a lot of money to own a house today. Banks want to see that you make at least your mortgage payment should not exceed 1/3 of your gross monthly income, whether it's individual or your household income. So you need to make a lot of money to get qualified. And when you do qualified, they nail you on those interest rates. So be educated, be aware, know what you're doing, so you can be smart consumer and not just any other consumer. I want you to be an educated consumer. I wanted to give you another scenario showing you an example of how by changing the interest rate, you could have lower interest rate, or by rates going up, how the banks make money or more money than they do. So in the previous example, I showed you that if you buy a house for $500,000 at 6.5%, fixed years for 30 years, they made a lot of money. But let's see what happens if you got that house, the same house that you bought for $500,000. Now you're buying it again, or in this scenario, at $500,000, putting 10% down, 30-year fixed loan, but your interest rate is only 3%, which they were a couple of years ago. And how much difference the banks make or how much less you pay. So I wanted you to understand that. So let's go through that scenario. Again, I'm going to summarize. A house is $500,000. Down payment is $50,000. The loan term is 30 years. Interest rate is 3%. So in this case, your payment will come out at $22.26 a month compared to $28.44 for the 6.5% interest rate. And which means that you are paying $618 less per month for 30 years. Every month you pay that much less for 30 years for the same house. And the banks are making less money, but they are still making a lot of money off of you on a 3% interest rate. So let's look at the percentage of the principal that you pay on a 3% versus the principal you paid on a 6.5% rate. So let's look at this amortization schedule breakdown and compare it to the one for 6.5%. So on this mortgage payment of $22.26 at 3%, if you look at July, the first month, the principal you will be paying will be $772, which is 34% of your total payment, and your interest will be $1125 a month. In other words, on the $2844 payment, you are paying 15% towards principal on your first month, but on the 3% loan, you are paying 34%. In other words, you are paying a lot more principal at a lower interest rate compared to a higher interest rate. So the higher the interest rate, the more interest you pay monthly every month. In this case, you are paying 34% principal on your first month versus 15% on the first month at 6.5%. And if you look at the total mortgage that you paid over the life of the loan for 30 years, assuming you don't refinance, is on a loan amount of $450 again, because you put 10% down. The total interest paid is $233,047. So the total cost of the loan for a $500,000 house at 3% is $683,000 versus it was over $1 million on the 6.5%. Now, the total interest or the cost of the loan is $683,000, which is still a lot of money. This is how much the banks make off of your house. But on a 6.5%, they made almost $300,000 to $400,000 more on top of what you made already on the 3% interest rate. As you can see, no matter what the interest rate, 2%, 3%, which is non-existent anymore, and I don't think we will see it in the next 10, 15 years, we will be seeing 5%, 6%, 7%, 8%. They will be making a lot more money next 4 or 5 years than they have in the last 2, 3 years. So again, the lenders, the banks, the greed comes in, they make the money while you become poorer and poorer. You might have heard a report, which I read 20 years ago, and I always keep it in mind. Did you know that 95% of all the people who retire are broke today? Yes, 95% are broke, and 95% need government help, Social Security help, or friends and family help or grants to survive. And one of the reasons is because they are cash poor when they retire, because if they are renting, the rents are too high because a lot of their salary is going out the door in rents and mortgage payments. I read another report in LA County, for example, these days almost up to 45 to 50% of the salaries are going towards mortgage payments and rent payments, which is ridiculous because by the time you do food and auto and loans and other things, you have zero left. So 95% are broke these days, but in the future, it may be even more because we are saving less and less and our expenses are going more and more. So be aware when you buy a house what your interest payments are, what your payments are. Buy below the means. It always helps to be educated and planning for the future. And knowing your interest rate, knowing your cost, how much your payments are, how long you're going to pay, all this really helps you to make a sound, wise, and educated decision. Now, a word of caution. I'm not giving you this information to scare you or take you away from buying a home, or nor am I saying that don't buy a house when interest rates are higher, because you never know what is high. Well, interest rates are 6.5%, which is higher than 3%. That was 2 years ago. But 20 years ago, they were 12, 13, 14, 18%. So they are lower than 18%. So you never know when the right interest rates are. You're going to buy a house when you are ready, willing, and able to buy a house. So buy when you are ready. Don't chase the interest rates and don't wait for the interest rates to drop, because you never know if they're going to go up or down. So if you're thinking about waiting, do you think that the rates will be down in 1 year or they'll be up in 1 year? Nobody knows. I don't know. You don't know. The government doesn't know either. But what if they do drop to 5.5% after a year? But guess what? Something happened and you lost your job and now you cannot get a loan. So you have to wait 6 months to get a loan. And then after 6 months, the rate go back up 6.5%. So never chase the market. You buy when you are ready, willing, and able to buy. But here are the 3 things I wanted you to take away from this video. Number 1 is don't wait to buy the interest rate, but be aware, be more educated, and be a wise buyer, and talk to several lenders before you're making that decision, and see how you can find the best interest rate and what's the best scenario for you to buy. Of course, you can always refinance if that's beneficial to you. If the rates are too high right now at 6.5% or 7%, after a few years, if they do drop, and hopefully they will, and I hope they do for your benefit, then you can always refinance, but hopefully you can also pay off the loan. So the way to fight the interest rate again is you can make extra mortgage payments every month, or if you have a lump sum amount, if you have a lottery win or a bonus from work, or you have inheritance money, you can always pay off extra, but check with your bank. Some of the banks don't even allow extra payments. Why is that? Well, they don't want to lose that monthly interest payment, so they don't want you to pay extra payments. Yes, there are banks that don't want you to make extra payments. In fact, some of the banks, if you pay more than 20% in the first 2 or 3 years, they'll charge you a penalty. So check with your banks how much you can pay every month extra or every couple of years. At the same time that you want to make extra payments every month so you can fight the interest rate and reduce the interest rate, you want to be aware that you have an extra emergency fund, emergency savings account in case something happens, medical issues. If you're married and you have a family, you need something for the kids. But if you have extra money, pay off the extra. So the first thing I wanted you to learn from this video is be aware and be educated. The second thing is there are ways to pay off your mortgage payments. You can pay off early. Like I said, I've done a video earlier, No More Mortgage. Please look at it. And in that video, I can show you that you can knock off the mortgage up to 5 to 7 years faster and save hundreds and thousands of dollars in savings just on interest by using those techniques. So I hope you can learn. And if you do buy a house, start doing that. I've sold some homes to friends of mine and have them make bi-monthly payments, which will save them 3 to 4 to 5 years in mortgage interest payments, and they can pay off in 25 years. And the third thing again that I want to mention to you about this video is that be prepared to buy. Yes, it is an American dream to buy. So be prepared, start savings, and not only start saving, but interest rates are made by banks. They charge you. Let me give an example. If you have a credit card, how much is your interest rate on your credit cards if you're not paying off every 30 days? 90% of all the consumers, and I'm assuming this, but I'm pretty sure it's pretty true, 90% of the people who use credit cards don't pay off at the end of the month. And you know what the average interest rates are on credit cards right now? 20%. My Citi card right now is 22%. My Home Depot card is 25% interest rate. Luckily, I pay them off, so I don't have to pay them. So if you are thinking of buying a house, and if it's 6.5% interest rate, start paying off your high mortgage bills, like your credit cards. If you have a car, and if it's 5%, 7%, 8%, pay it off. If you have furniture that you bought and you're paying 20, 17%, pay that off. So the way to make money is to stop spending the extra money that you can avoid. And the best way is to stop paying those higher interest rates. Because in the savings account, you're getting 1%. So it's not even worth it. But if your mortgage rate is 3% right now, you may not want to make the extra payments, extra $100, $200 payments, because you may want to buy funds or stocks or other things and invest because you can have a higher return than 3%. But if your interest rates are higher, then you want to pay off your other credit card bills or other high interest credit card bills. Hope this makes sense. Please watch this video. No more mortgage.